from that.
Do you want to use my democratic finger?
What?
This is my finger in Spanish is dedo. So do you want to use my democratic finger? It's like a word for democratic, but me telling you.
Okay, yeah.
It's like
Yeah,
nothing
this
that
is the democracy of values.
Yeah.
If you don't make eye contact, it doesn't work.
I can
You can't
poke
see
you
values,
with
you
it.
can't see
It's based on emotion.
We'll go. We'll start.
You guys are.
Yeah.
This is like the T-Rex
I
democracy.
like it.
Okay.
So for hiring, one main thing is alignment with our mission and our vision. It's really big. Enthusiasm is also important. You know, somebody who's willing to not just like, oh well, I guess I need a job today. That's important. They dig co-ops. We need somebody who digs
They
co-ops.
have to dig co-ops,
Literally.
like, they have to
And figurative.
they have to like to dig.
Which that's the next point is somebody who can work hard or is willing to work hard, regardless of innate ability, but just willing to work hard.
Oh, those are the most important things. And I also want somebody who's reliable, somebody who's honest, and people who are willing to participate in meetings, people who can take on different roles. And then we have we're also looking for people who are not just white males, so we say that by saying we don't discriminate against blah, 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 but in fact, we're looking for women, people of color, all ages and backgrounds, so.
Next.
Who wants to go next?
For us, we have aptitude, risk, and access. And for aptitude, we're looking for the person with the proper skill set, so they could do the job properly, and we know that they're motivated to do it. And for access, we are.
Yeah. So for risk would be choosing somebody who really doesn't have a job or isn't really involved in extracurricular activities or anything like that, or is at risk of failing in college or something that probably won't end up doing anything. We'd rather hire that person over somebody who's actually active, so giving that person a chance basically.
And access, we're looking forward to if your family or something is looking for the job, we're looking for them too, because we actually have connection with the family stuff. So it's easier for us to hire someone that is related to the person working with it, so it's easier for us.
So I think some other youth employment programs have a model where they actively have a policy where they don't hire siblings. So if one teenager is hired, they won't hire a brother or sister. But we have the opposite policy because we don't think that's fair. But also because we think it helps us to build stronger connections to the whole family as a whole, the parents and longer term, especially if it's younger siblings down the line, you have that history of connection, and we like building those relationships.
It's really funny because it's the same way that is at the EJ League and with the bars, they try to reach the whole family. So a lot of the times brothers and sisters back first. That's good.
And then too, as that's the main policy for the core youth, but as it goes up, we have others roles, youth leader and junior staff, the same kind of standards apply, but also it's more in depth, through what we've observed through them already working with us. But I think that ours are really unique just because we are hiring youth and we're looking for somebody we can help more than they can help us.
And we hire a lot. We interview over 200 people every spring. So we spend 3 months of the year hiring. Wow. That's a lot of what we do.
A lot of training, right?
Yeah.
Wow.
And we do a lot of interview training before we hire and resume building and lots of training people to be on hiring committees, so it's like a big part of our program.
Do you think it's rewarding? No.
Yeah, I mean, it's rewarding because a lot of youth get the opportunity to be on the other side, so you're chair the interview, but then to actually be able to be the interviewee, right? Interviewer. That's rewarding also because it makes your interview when you actually go to get hired somewhere a lot stronger, and you can see from both aspects. And then also it's good to be able to be like as a junior staff. I mean, me, Grace, and my coworker, we manage the hiring process for these where it's 10 spots and 200 applications. So to be able to say that I did that is like, okay, now I have that for resume. So that's rewarding. And it's a cycle. Like all the youth are gonna have that opportunity. So I think it's good.
Anybody else? Has somebody thought about why you don't want to hire?
We got a list.
Wait a minute.
You guys,
More likely not.
We have a good list. We don't want capitalists, negative or grumpy people, hermits, dogmatic or sectarian people, selfish, lazy, racist or homophobic, people who threaten our safety, and then we also do have like a list of like diversity goals, which includes like no more than 50% cisgendered white men, less than 20% of people in their 20s.
Yes.
At least 10% queer. Yeah, so taking into account immigration status, ability, things like that.
Are you worried that like having such tight percentages will cause problems? Because I know people who've been in organizations that utilize that and then have actually experienced being like declassified. Like I had a friend who's half Latino and half Jewish, and she was moved from a minority classification to white, and then it like caused someone else. Yeah, it ended up making her leave the organization.
Well, we put there that we strive to that,
Yeah,
to
I think
have
we're
that, to use it as a guideline. It's not like we cannot actually legally put it in our documents.
Yeah.
So, but it's something that we're looking forward, like
Yeah.
constantly when we thinking and inviting. It's more like who you invite, because the difference in a co-op is you invite people sometimes to just do trainings, right? So you have that ahead, who you're gonna target first and why. I mean, if you then just have women of color and half of them are queer, then it's also a problem, right? Like you maybe not. But I don't know. So I feel like it's just more like what our mission is, and for our mission to be accountable to that mission, we have to meet that. 1.5% X.
I think it's also more towards like not having too much of a like dominant group. So I don't think like in that situation, like it's also self-identified. Like we're not gonna.
We're not
If
gonna
someone is
tell
like
you.
I'm multiracial, we're not gonna make them. Yeah.
Give us the papers.
Yeah.
Well, maybe in the last 2 weeks we could have more time to talk about whatever we have more stuff, but I think we have to move on, right?
Yeah.
Okay. Awesome. Thanks. And the other two things in there are challenges for next week. The evaluation.
Yeah, so there were 2 worksheets in your packet today. One was a member evaluation worksheet, or a peer evaluation worksheet. You're right, that's a better term for it, and that's what people usually call it. So this is a worksheet that's to get you started thinking about what should be in your evaluations. Does anybody have a peer evaluation already in place, or do you have anything like this? Okay, you have something like that? Okay. for homework, I want you to go through this worksheet, and the other one, the grievance procedure worksheet, which is pretty simple. It's just imagining what your grievance procedures would look like. And I think you didn't get the stuff that you had on the overhead. Is that going to go out on the email?
I can, yeah.
Yeah, because that seems like it would be useful to reference when doing this grievance procedure worksheet. So this is going to help you like create your evaluation procedure and your grievance procedure. So we'll come back to that next week. So the next thing that we want to do is actually, let's see, which thing are we going to do next? I think we're going to do this thing next. So I was a little confused, I guess, about what you guys did and didn't do last time, and I missed something. Did you guys, who did their homework on the cost of, or the break-even point? Or first of all, who did their overhead expense sheet? Did people get to that? Overhead expenses? Did you kind of do it, or did you finish it? Kind of did it. Who else did the overhead expenses worksheet? Haven't done it. Okay. All right. Well, good. Good thing you haven't done it, because we didn't put it on the agenda for today. So we're definitely putting it on the agenda for next time. So I'd really like you to get that overhead expenses sheet really looked at. It's very thorough, but I think you'll find it's easier than you think to kind of fit it in. And what you can do is, if you don't know about something, just make your best guess and leave yourself a note. Like literally a sticky note or whatever it is you want to do to come back to it. Because these are things you're going to revise over and over and over again, right?
So we went through, just because we are in our current state connected to a larger organization, and so we just went through and classified each expense as like, we're going to share this expense with the organization that we're hosted by, or we're going to handle it independently. And
Do you have a separate bank account and stuff?
No, not yet. Well, we will have a separate bank account, but there were some things that were in there, like rent for office space, where we have the same office space as the organization we're based out of. So like,
okay, I want you to imagine it as if you're an independent organization, if that's your goal.
What percentage of that rent would you contribute to, for example? You need to think about that.
Right.
So,
Yeah.
so, yeah, some of these things are hard because you have to figure out some things before you can figure out other things, like the insurance, so you have to have that, you have to know your business expenses and income and.
Right, Matt and I were just talking about that. Yeah, when you call, I forgot about that. When you call the insurance company, they're gonna want to know what your projected income is.
Yeah.
And I would say, and it's true we haven't gotten there yet, so it's a bit of a circular procedure. So I would make your best guess and tell the insurance company that. It's gonna be pretty, it'll vary pretty directly.
So I went through an online insurance company to get an online quote.
Okay.
And I made guesses, probably not very good ones, because when I got to the end of the process, they said, well, we can't give you a quote.
Really? Okay.
And referred me to somebody else, and I have to go through the.
that happened to us too.
Yeah. So
Yeah.
something is a little.
Well, I would have been surprised if you'd been able to get a quote without talking to a person. I mean, generally there needs to be a person on the other end of this process. And, huh?
No, I was just spacing out here. Thought maybe she'd wandered onto Obamacare and says, couldn't give her.
Why can't I make this go?
So talk to somebody.
Are we gonna go over the funny
Try
homework?
humans.
The which one?
The funny homework,
Yeah,
the Yelp one?
You'll probably need a short description of your business, what kind of things you're doing. If it's landscaping, it's pretty obvious, but you probably need to put some parameters on it, like not snow plowing,
We just
what kind of
axons-
heavy equipment,
axons
those kind of
planned,
things.
that was fun.
And then a projection of income for the first couple of years.
Right.
Your best guess. And what our broker said was, don't over exaggerate, it doesn't help you. If you think, oh, we're gonna do, $200,000 worth of business sales, and then you end up doing 80, you're way overpaying for
Right.
insurance.
Right. When it comes to workers' comp, you tell them how much Workers' comp is based on how much your payroll was in the previous year, and they'll ask you for an estimate of what your payroll is going to be, and they'll base your workers' comp policy on that. At the end of the year, you'll get audited. Every year you get audited by workers' comp, and they come and they check out your payroll records, and they compare it to your estimate. And if you actually had a higher payroll than you told them, you're gonna end up owing a lot of money. One time a company that I worked for ended up owing like $10,000 in the middle of March for a construction company. It was not pretty. So you want to be careful about that. So, but I don't think, but liability insurance doesn't work the same way. You're not going to get, it's not, just give them your best estimate of what you think it's going to be. And tell them you're a startup and you haven't started operating yet. Tell them it's going to be between this and this, and they'll give you a quote based on something in between.
Okay, but
That's
talk
fine.
to somebody is good.
Talk to a person, yeah. I mean, I don't think you're going to get the information that you need by filling out a form. Yeah.
And for us, it's really hard. I tried, and they told me it's just one farmer's insurance, like it's nothing else. Workers' comp doesn't recognize farmers for workers. It's just like
Okay.
a lot of the stuff were really different. So
Okay. Did you manage to get a quote for farmer's insurance?
they sent me to somebody and did research. So I
Okay.
recommend
So that was
someone.
definitely one of the recommendations. So there's insurance companies, right? There's like, I don't know, Liberty Mutual, and there's the Ben Franklin thing, and then there's the whatever. Then there's insurance agents, and insurance agents are different than insurance companies, right? So insurance agents are often like right on the main street of the downtown, and the agent will go out to multiple insurance companies and get you the best policy that they can. So you want to find an agent that understands your industry, right? Because somebody for the construction industry is going to be totally different than the farming industry. So you need to find an insurance agent that works in your industry.
We found an insurance group that works with farmers markets, so they might be able to refer you. It's Flip program, and they work specifically with cottage industry and farmers markets.
Yeah, the insurance industry is very old-fashioned. It's definitely a word-of-mouth thing, and it's definitely an ask around until you get a good reference sort of thing. So, yeah, keep going on that homework. So keep going on the insurance thing, keep going on the overhead expenses. We don't have that many weeks left. You're going to make the best of your time if you have all those things before the end of the Co-op Academy. We'll go over the break-even point next time. We're introducing a whole new thing here, which is going to be important for everybody to understand. So I'm asking a lot of you at this time of night, but let's do it, okay? So these slides are from Melissa Hoover, who's the director of the U.S. Federation of Worker Co-ops. She's a brilliant person, has a lot of experience as a bookkeeper and a financial manager for cooperatives. And so she made this kind of animated slideshow that I'm going to talk through with you about what happens to your capital investment, okay? So remember the lemonade stand and how all the members of the lemonade stand put in $10 at the beginning of the thing, and the value of their $10 investment went down a little bit and then it went back up. So imagine this. Here's 3 members of a new and different cooperative. It's not the lemonade stand anymore. The members each put in the same amount of equity. They bought their shares in the cooperative, right? And when we start, they're all the same. Okay? So this is the equivalent of the $10 share, of the $10 investment in the lemonade stand. So now, we operated, the first year happened, okay? This is the, shoot, I watched those YouTube videos and now I know that I say okay all the time. So now I'm going to be really self-conscious of it. Anyway, so,
It's okay.
the first year, did you guys all notice that? Am I the only one who didn't know? Yeah, I say okay
I
constantly.
think everyone does.
Yeah, I
I
have
feel
to
like
notice
that.
it.
And like when he points it out, I'm like, oh,
I'm like,
yeah.
Great.
Force marker.
Okay, so this is our profit and loss for the first year, right? Does it look familiar to everybody? So we have our income. We made $500,000 in income. This is the main thing that the liability insurance company wants to know about, by the way. They don't care about this. They only care about how much your sales did, just by the way. So we made $500,000 in sales. we had a combined direct and indirect cost of $450,000. So we made a net income of $50,000. Okay? So what's our net profit margin? What percent net profit did we make?
10.
Anybody else? We made 10, right? $50,000 is 10% of $500,000. So we made 10% net profit. So here's what's going to happen. So now we're like, at the end of the year, we're going to figure out what we're going to do with this profit, right? So first one thing happens, and I'm just going to gloss over this part for a moment. There's profit that was generated by members and profit that was generated by non-members. Those two things are taxed a little bit differently, but we're going to come back to that later. But for now, let's just say, let's look at the $40,000 that we made in surplus. Does anybody remember early on I said that what we call a profit in a regular business, we call surplus in a cooperative? Because we operate at cost in a cooperative, right? And we don't get dividends back, we get refunds back on our investments. Because at the end of the year, in a workers' co-op, if there's extra money left over at the end of the year, it means that the co-op could have paid us a little more money. And so we get a refund. We get like maybe 25 more cents for every hour that we worked, right? So here's how it works. So that $40,000 is the surplus that we generated. We ended the year with $40,000 extra. Whoops, it's a happy accident. We tried to operate at cost, but we ended up making a surplus because we were good and conservative about it.
Does that include like saving money too?
Yes.
You operate at cost but still have money in the bank.
Yeah, any money that you plan on saving, and here's how it works. So we have $40,000, and we do two things with it. We have to decide how much of it is going to go in our collective account, and how much of it goes to our patronage dividends. Some people don't like calling that dividend for the reason that I just said. It's called a patronage refund usually, but let's just say patronage refund, patronage dividend. So what this co-op did at the end of the year, they looked at this at the end of the year and they said, okay, we have $40,000 left. They had their annual meeting and they said, what do you think we should do with this money? And they said, well, we definitely need to hold on to some of it because we need the cash. We want to buy another truck, you know? So we're going to take 25% of it and put it in our collective account, okay? We're going to take the other 75% of it and allocate it out to our individual members. And this is where it's going to get complicated, so stick with me, okay? So our individual members. The money that we pay out to individual members goes to two different places. So it divides twice, right? We divide it this way into individual accounts and collective accounts, then we divide it again. The way that we divide it the second time is we pay out some of it in cash, and some of it goes into, sorry, this isn't totally out of focus, goes into our internal capital account. I guess it wasn't out of focus, that's as good as it gets. So it's also called retained patronage here, but usually it's called an internal capital account. So here's what this means. When you're an entrepreneur, you're an investor in your company, okay? And this is the amount of your investment for now. So back on the previous slide, you invested your member equity when you bought in to the co-op. Maybe it was $1, maybe it was $1,000. And then now you have this surplus. So what we're doing is we're saying some of it gets paid out in cash to you that year, and some of it stays in the co-op because that's your investment in the co-op, and that's you helping capitalize the co-op. That money still belongs to you. It's got your name on it, literally in the books. It's got your name on it. But you've agreed to leave it in the co-op for an amount of time.
Proportional to your.
Yes. So it looks like this. So member number one, let's see. Member number two gets $3,000 back. Member number one gets $2,500 back. Why does member number two get more money back?
More hours.
Because they work more hours. hours. So it goes back to on the basis of how many hours they worked, not how much money they made. Because the idea of it is a refund, right? So like, let's say member 1 was making $15 an hour, member 2 was making $20 an hour. They get, each one of them gets, let's say, 25 cents for every hour that they worked. Not for every dollar that they earned, right? So now we've bumped up member 1's rate to $15.50 an hour. We've bumped up member 2's rate to 20 and 50 cents an hour. Does everybody get that? So we've bumped up everybody's, we had extra money, we bumped up everybody's wages a little bit. We gave them a little more at the end of the year. But they only get half of that in cash. So half of it stays in the co-op. Here's the really complicated part. You pay taxes on the whole amount that was allocated to you in the year it was allocated to you. And this shows up. This shows up on your taxes depending, it depends on how you're organized, whether you're an LLC or a corporation, and whether you're taxed as entrepreneurs or as workers. But if you're taxed as workers, this is going to show up to you as additional wages. But no taxes have been taken out on this. Like, this didn't show up in one of your regular paychecks with taxes taken out, so you're going to owe taxes on this at the end of the year. The reason why we pay some of it out in cash is to make sure you have enough cash to pay those taxes.
So if I decide I want to leave the co-op and I want to pull out all the money that I've invested in it, and I know you said before, like, there's usually a policy, maybe I do it over 3 years.
Right.
So over 3 years, I'm pulling out like $10,000.
Yeah.
I've already paid my taxes on that, so I'm going to get it very clear.
Yes.
You don't get taxed twice.
Right.
Sweet. Awesome. So that's kind of an incentive to leave the co-op.
If you're not good at saving money on your own, this is a way of saving money. But you're also taking a risk, because so you leave the co-op, and 3 years later, if the co-op has fallen on hard times and it has totally tanked since you left, and they don't have the cash to pay you, you don't get that cash. So it's a very risky proposition.
Does that percentage change sometimes? It's not always 50-50, right?
Right. In fact, it's not usually 50-50. It's more typical to pay out 1/3 of this, because 1/3 of this amount is what you're going to get, is probably about the tax you're going to pay. So member number 1 is going to receive a statement at the end of the year. Is going to receive a W-2 at the end of the year with all of their wages and the taxes that were taken out through their paychecks. They're also going to get, most likely, they're going to get another form called a 1099 miscellaneous income. And it's going to say, member 1 got $5,000 extra dollars. And you're going to have to pay taxes on that $5,000. It's probably going to be about 1/3 of that. So the reason why you get the 1/3 is to cover that, so you're not creating a tax liability. There's 2 ways you can do this. So both of these percentages, this 25% that we put aside for its collective account, and the 75% we put here. So this time we did 75 and 25. This time we did 50 and 50. You can either set this in your bylaws so it's the same every year, or you can decide every year, depending on how your co-op did, what you want to do.
Wouldn't it make more sense to put more of the money into the collective account, where it's increasing the stability of the business and it's not a tax liability from the owner? It doesn't seem to me like there's a ton of incentive to keep it in this account versus that one.
That's where one of the tensions comes into play about the collective and the individual, So if you are, it's true that the more money you keep in this collective account, the more stable your business is going to be.
The more less incentive there is for people to pull out their investment.
Yeah, I guess that's true.
Unless
If their
investment.
individual investment doesn't build up that high, it's weird. You're creating this kind of tricky situation where it's like, the more equity a person has in the business, the more invested the more invested they are in the business, but also the more they stand to gain if they leave.
Yeah.
That's why you set it up so that people get the money at a certain schedule, whether they leave or not. So a lot of co-ops set it up this way, that basically that after, even if you haven't left the co-op, after 3 or 5 years, your patronage that was put aside in year 1 gets paid out to you in year 3, for example, whether you left the co-op or not. it seems to be a better system that way, because then no one person runs up 20 years worth of equity in the business when everybody else only has 1 or 2, right? Because then you're going to make different decisions. If one person has $50,000 in the company and everybody else has 2, that person is going to be like, well, wait a minute, you know, this is my retirement money you're bargaining here with, you know, so we have to be careful with this. So you want people to be more on a more level playing field. So the way that most co-ops do it is they give you a 3 to 5 year period where everyone leaves their money in for that amount of time, whether you leave or whether you go, whether you stay or whether you go. And even if you're still in the co-op, you get that money paid out after 3 to 5 years typically, but you can set it up any way you want.
And then after 3 to 5 years, theoretically, you get like a dividend every year.
Your dividend, you already got your dividend in the year it was allocated to you, and all you're doing is taking the cash out. You're drawing the cash out of the business. They're paying you back.
And theoretically, that would happen each year.
Yes.
If you were doing well.
Yeah, as long as the business is doing well. This is why you have to plan ahead for cash. You have to know how much cash you have. You have to do really good bookkeeping so you know how much money you owe these people. You know, you don't want to get caught not having the cash to pay this. Yeah.
I'm still a little caught up on the retained patronage, so I'm trying to understand what exactly it is. Is it like, so you invested in the co-op and it's kind of like a return on your investment, like it grows with the amount of time you're there?
That's exactly
Because
what it is.
I guess my understanding was that like if I invest in a co-op, I'm guaranteed to get my investment back, but I didn't know there was like a growth model where like there's an increase.
So there is and there isn't. So originally we put in the same amount of member equity, but all these members work a different amount of hours. They all got a different amount of member retained patronage. It gets added into their internal capital account, right? The one thing that doesn't happen is that, so you know in a regular stock corporation, like the NASDAQ and the Dow 500 and all of that, they're talking about the price of shares, the price of stocks. The price of your stock doesn't ever change, okay? This green box here does not grow or shrink the way that it does in a different kind of stockholder or corporation. The price of your share is always the same. But you also have this internal capital account where the dividends that you earned by this co-op making money, right? So what would have been the owner's profit is now your surplus, and that goes into your internal capital account. And the longer you stay, the more of it you're going to have, except if you have bad years, right? So what happens if you have a bad year?
You lose your,
What is this?
Lower.
Deficit.
It's a deficit. So this would be surplus minus $40,000, right? It could very easily be that. I've seen it many times. So there's 2 ways you can do this when you have a deficit. You can do exactly the same thing as we did here with minus signs everywhere. You know, we could put 25%, we could take 25% away from the collective account, take $30,000 away from everybody's internal capital accounts, deduct that much from everybody's internal capital accounts. Or you can say, which I actually just learned this yesterday because a co-op that I'm working with, their lawyer recommended it. It was news to me. You can actually say if the co-op has a loss, then 100% of the loss gets allocated to the collective member account. Now, why is that fair? I was like, I'm not sure if that's fair or not. But the logic of it goes like this. So if we had a good year, we made some extra money. Everybody gets a little bit more depending on how much they worked. People who worked more get a little bit more money than people who worked less. In a bad year, we lost $40,000. We have to allocate that loss somehow. Do we allocate the loss so that the more people worked, the more they get deducted? And the less they worked, the less they got deducted? It could be that the person who was working a lot more was doing a really bad job and that's why you made less money. But it could be that the reason we lost money was because those other people weren't working enough and they should have worked more. So it's like, maybe that wasn't quite such a fair arrangement. So you have the option of saying, if we have a loss in any given year, we allocate that 100% to the collective account. So if we have a loss of $40,000, let's say there was only $10,000 in this account, that means that we have a negative, negative 30,000 in this account, which could be fine as long as your business still has cash. So what that means in effect, if you do that, just stick with me one more minute here. Let's say that the previous year you had put $10,000 in this account, right? You had $10,000 in your retained account. This year you lost $40,000 and you allocated that all to your collective accounts. So that's minus $30,000 is sitting in here now. You still have $30,000 that were sitting in here from the previous year, right? Not sitting in there, they've been allocated out, right? So if this is minus 30 and this is 15, if this business shuts down tomorrow, are you getting that 15 back?
No.
It's not, it's not there. It's not there, is it?
So, I'm stuck on another point about, who works and who doesn't.
Yeah.
Or, because it makes sense to put it all up there if everyone has equal access to work. And
Right.
then the people who want to work, then the people who work more, if everybody has equal access to work,
I think
if people do not have equal access to work, then the people who work more, it seems to me, should accept more responsibility for the
it could be.
loss.
That could be what makes sense for your group. Yeah. It could be that if the people who worked that year didn't manage to make a profit, then they should absorb the loss. And if that's what you decide is fair, that's what you put in your bylaws.
Would you mean that?
Could it be
Would you mean that you?
Yeah.
Would you mean that you'd be taking more out of the retained patronage than out of the collective
So
account?
all of this would be,
If you wanted it to be more on the shoulders of the people that work more, you'd take it more out of the retained patronage than the collective account?
yeah,
Well,
so
put it all in
everything
the collective
here would
account.
look the same, except everything would have a minus sign in front of it.
Right.
So you'd have $40,000 of a loss, you'd allocate $10,000 of it into this account, you'd subtract $10,000 from here.
It'd be a little different, right? Because it'd be $30,000 subtracted from the retained patronage because there's no subtraction in cash payment.
That's true, good
There's
point.
no paying in.
So you're not, okay, that's a good point, Asa. So no one's, very likely, you're not gonna be asked to pay
Yeah, unless you're
the money
completely
back
failing.
in.
Yeah.
Unless it's a
Unless you're
matter of
falling
life or
apart,
death
yeah.
for the business, and your business is actually going to fail unless you get cash from somewhere. So you're right. In that case, it would be, it would be $30,000, the whole $30,000 would come out of here.
I didn't get the point.
That will be a little bit more fair.
Well,
Well,
I think
that's
it also
the-
has to do with cash flow of just like the business in operation.
Yeah, that's how much cash you have.
So like, it's not like, this is like in the picture in the movie thing. This is a picture, but like the movie would still be happening. So if you were grabbing a movie in or out of products or services, you could have cash on hand, and both of those accounts could be in the red, but you could still be able to be moving forward enough to like
In the black.
get back in the black.
So,
Jen has a question.
I have a question about just like, you can just decide what your fiscal year would be. If you're like a farm, you can decide, I wanna do it at this point of the year because this is when, or,
when you set up operations, you choose what your fiscal year is gonna be.
yeah.
And you should think about that carefully, because that's one of those things that's really difficult to change later.
Yeah.
There's a lot of things you can change later if you decide you didn't like it. You can change your bylaws, you can change your articles of organization, but your fiscal year is just a pain to change. So,
We have to close everything and open it up later if we want to do that.
yeah.
So what kind of things do you consider when you're deciding when your fiscal year is?
If you're part of an industry that has a certain break at the same time every year, then it might make sense for you. Most of the time, it's going to make sense for you to go January to December. Like, if there's not a good reason to choose something else, then just choose January to December. But for a farming organization probably does make sense because the season happens mostly in the middle of that time.
Fiscal year is July, though, so a lot of people line up with that.
Yep, if you're, exactly, yeah. If you have a lot of government contracts, then yeah, it might make sense for you to do July to June. I know some housing cooperatives in Boston that have a lot of turnover on September 1st, so they make their fiscal year September 1st because that's what makes sense to them. But whatever it is, you should think about it ahead of time and choose well because it's hard to change later. So we didn't cover a whole bunch of things tonight, but we are out of time. What did we not cover and what can we do about that? Sorry about that. Everybody. Yeah. So I think it's important to spend time on this because this is really key to a cooperative, and you're going to be in charge of making these decisions. This is a member's decision. Nobody's going to make it for you. So you guys have to understand this.
Is this going to be available to us?
Yeah, that's going to be part of the wiki thing.
It's already on the wiki, and I'll send that.
Also, like, if you email us the worksheets, can you send them in non-PDF file or JPEG file? Because most of them are in JPEG, but those 3 worksheets that were.
I usually send them as Excel files so you can actually fill out.
Yeah, that's
the
right.
Yeah, we just saved all of them in a file, and we found, I think, like 2 that we couldn't.
3 were JPEG. It was the first worksheets that were very similar to the ones that we got this week, actually. These ones. They were like very similar to this one, just very basic and
From earlier weeks?
It was like
Yeah, okay.
the
Yeah,
first
okay.
one. Yeah.
Okay, so the part of today that we missed was actually the part that we also missed last week. So it was the taxes and year-end accounting. So we'll just put that on the agenda for next time. You guys got handouts
Maybe
about
we'll
that
do it.
last time, I think. Yeah, maybe we can get Sarah after all. So we're over time. Thank
Can
you.
we